Hey everyone, and welcome. Today, we're going to break down a real world case study of some seriously disciplined trading. We're going to look at how one trader handled two totally different positions to lock in a pretty solid day of profits. Look, this isn't about hitting the lottery, it's all about smart strategy. So let's dive right in. And let's just get right to the bottom line, shall we? After all was said and done, the total realized gain for the day was $890. Not a bad day at the office at all. So the big question is, how did they actually do it? And, maybe more importantly for us, what are the repeatable strategies here? What can we pull from this one day of trading and apply to our own? That's exactly what we're about to deconstruct. All right, first up was a trade on Tesla. And as you probably know, Tesla is a notoriously volatile stock. It can be a real roller coaster. But this wasn't just some wild bet. Nope. It was a defined risk put spread, a strategy that's specifically designed to cap your potential losses while you aim for a more predictable profit. Okay, so what you're looking at here are the two closing transactions for that Tesla trade. The strategy, a put spread, is basically a bet that the stock's going to go down, but it has this built-in safety net. You do it by buying one put option and selling another one at a lower price. It caps your potential profit, sure, but it also caps your potential loss. To get out of the trade, you have to close both of those positions, and that's exactly what's happening right here. Let's break down the math real quick. So the trader closed their long 335 put for a nice gain, over $650. But to do that, they also had to close their short 332.5 put, which resulted in a loss of about $500. The difference between those two, a net profit of $150. The key here, the whole point is that the profit on one leg more than covered the loss on the other. And this right here is such a core principle of good risk management. The goal wasn't to hit a grand slam. It was just to take risk off the table. A guaranteed $150 profit is so much better than letting a winning position turn into a loser because of greed. You gotta remember, green is green. Securing profits, no matter how small, is a huge key to long-term success. Okay, let's move on to the second trade, because this is where the real action was. This is where the bulk of the day's profits came from, a position in IBIT, which is one of those popular Bitcoin ETFs. Now notice something really important here. The trader didn't just sell all their contracts in one big chunk. Nope. They sold a block of 4 contracts first, and then, a little later, another block of 11. This is a really powerful technique called scaling out. It lets you lock in some of your profits while still leaving the rest of the position open for even more potential gains. It's a smart way to play. And the profit math here is pretty straightforward. That first sale brought in over $150. The second, much larger sale secured another $583. Put them together and you've got a realized gain of about $740 from this one position alone. And what this shows us is a super important strategy for volatile assets like this. Selling when the price is already moving in your favor, what traders call selling into strength, is an absolutely crucial tactic. It protects your capital, it makes sure those paper profits turn into actual cash in your account before the market has a chance to rip back in the other direction. But wait, the story isn't quite over. After locking in all those profits, not every single position was closed out. And this is where the strategy gets, a little more advanced. This is where we get into the concept of playing with house money. So what on earth is house money? Well, think of it like this. You go to a casino, you win big on your first hand of blackjack, and then you put your original stake back in your pocket and only play with your winnings. In trading, it's the same idea. You've already banked enough profit from a trade that you can let a little piece of it keep running. Your original investment is safe and sound, and now you're just playing with the market's money. And that is exactly what happened here. The trader left 3 of those IBT call contracts open. These 3 contracts are now essentially a free shot, a lottery ticket for any more upside before they expire. There's zero risk to the original capital anymore. So that brings us to the final act, the game plan for the last 48 hours. How do you manage these house money contracts to squeeze out any last bit of profit without getting reckless? Let's survey the battlefield, okay? IBIT is trading around $40, and there are just 2 days left until these contracts expire. Now, the biggest enemy is time decay, what the pros call theta. It's this invisible force that just eats away at an option's value as time ticks by. But there's also a huge opportunity if Bitcoin can finally break through that big $72,000 resistance level. And check this out. There's this fascinating contrarian signal. retail traders are showing extreme fear, which, believe it or not, can sometimes mean a sharp move up is coming. So this all sets up two very clear scenarios. In scenario A, the best case, Bitcoin surges, IBIT spikes up towards $42, and the trader sells those last 3 calls to lock in the final bit of profit. Sweet. In scenario B, the market just kind of drifts sideways, chops around, and that pesky time decay just bleeds the value of those calls all the way down to 0. And since it's house money, that's an okay outcome. But you're still playing for scenario A, right? So after taking that entire day apart, piece by piece, we can actually boil these actions down into a simple but really powerful playbook. This is how you turn a series of individual trades into a strategy that you can use again and again. Let's walk through it. Step 1, define your risk. That's exactly what the Tesla spread did, right? It put a hard cap on the potential downside. Step 2, take profits systematically. That was the IBIT trade in a nutshell, selling into that strength to turn a good position into cold, hard cash. And finally, step 3, let your winners run, but do it wisely. And that's the house money concept with those last 3 IBIT calls, a totally risk-free way to try and capture more upside. And really, that just says it all. Combining these tactics isn't just about making a quick buck. It is, quite literally, a textbook example of professional risk management. It's all about having a plan for every single stage of a trade, from the moment you get in to the moment you get out. And that leaves us with one final thought. We've seen how these principles worked out in this real-world example. So the question I have for you is this. What's the single most important rule in your trading playbook? What's the one thing you do that protects your capital above all else? Thanks for tuning in.